All right, for tonight's my last discussion night for this class. So our last chapter, chapter 15. I will open up the exam. Tonight already. So if you want to take the exam after class, you certainly can. We will finish early. Tonight's going to be a shorter night because the content is not that long. It's basically using ratios to compute answers in our financial analysis part of our course here, or this chapter itself. However, remember, I will be here next week on Tuesday night if you so choose to come and take the test here at school. Or, like we have been dealing, it's open till Wednesday of next week, the 8th. So we've got basically a full week to finish up the exam, and that's it for the class. So if you are planning on coming in on Tuesday night, do me a really big favor and let me know. Okay? So that way I might be able to see my son's baseball game, maybe some of it. So, but just let me know. Okay? All right. For tonight then. Chapter 15 begins on page 837 of our book. And the Apple company is the company profile for this chapter. And it's pretty interesting just to read some of their ratios that they talk about in this profile, considering how big of a company it is. They're making 23 cents on every dollar of sales. So pretty good margin for their particular overall company operations. So if you get a chance, read through that. They make a lot of money and they have a lot of cash. Also, in order to, give you a summary of all the ratios that are in chapter 15, I decided to put it on one page for you. And if you'd like, these are a lot of the ratios that I use quite often when I'm consulting with a company to go over their financial records. So I broke it down just like the book does into parts, starting with liquidity ratios, cash, right? Cash flow, really so important in the liquidity area. Leverage is basically debt equity, right? How much or what did we use to pay for our assets? Did we use long-term debt from a bank, or did we use the common shares or shareholders to finance our asset purchases? And then it wraps up on the back page, number 3 here, with all the profitability ratios. So no matter what size of company you are, if you're Al's Hamburger on Main Street and you want to compare yourself to McDonald's with ratios, you can do that because it's a very good measurement, compatibility measurement versus actual absolute dollar amounts. So ratios are key in that analysis. It also helps when comparing from year to year. Using ratios is a much better number to use than absolute dollars in many cases. So we'll cover most of these tonight, not saying all of them. They have these life examples also in the chapter. Here they want to determine whether they should buy a house or rent. So that's information that can be used in this analysis, trying to get you to a real life analysis. But we're going to start with our first ratios, computations, looking at a common size analysis. comparing last year to this year and looking at by line item, right, on the financial statements. And we've got two different types. One is called a horizontal analysis, and we've done these in accounting too and others, and a vertical analysis. Horizontal is what we're going to start with. With horizontal, this picture shows that we're comparing one year to a previous year, right? So this is the horizontal analysis. Vertical analysis is looking at the line items vertically. On the income statement, our denominator is sales with a vertical analysis. On the balance sheet, our denominator on the bottom is assets. So everything is based on that denominator in the vertical analysis. Horizontal, we're just comparing one year to the prior year. So the examples for the horizontal begin on page 839 of our book. Page 839. And what's nice about the horizontal, it's good to show trends. How are we doing on a line-by-line item basis across multiple periods of time? The example that we're going to use is example 1. And with this horizontal analysis, you have to pick a base year. What year are we using as our base? So in this case, they're using base year 1. And then from that base year, they're showing on this answer here a percentage of change of difference. So if you look at this, they went from 100,000 to 120. That's a 20% increase. Or if I multiply this by 1.2, I get the 120. If I go to the second or third year, I'm multiplying it by, in this case, 1.32 to get my percentage of increase. Just put it over there. So in other words, the author goes 132 over the base year, which is 100. That's 1.32, but they want this as a percent, so it's 132% of base year. So everything's based off that base year in this case. So the denominator is the base. This is horizontal analysis. I've not seen this so much in my years. I'm more of a percent change kind of guy versus a base year kind of guy. So, but that's the difference. So let's just try one. This is problem 39. This should be in your packet on page 879. I put down the dollar amounts for year 2. I put down the dollar amounts of year 2 already. So just copy those down. So 1.2 million for the sales, 700,000 for the cost of sales, and so forth. If you want to put year 3 numbers down too, you certainly can as you're going through the list. And all we're going to do is compute our percentage of base computations here. and we're looking for trends here. Once we look at our percentages. Okay, we're pretty much through. If not, we can get caught up as we do some of our computations. So remember, it's off a base year. So as an example, I'm going to take 1.2 million of sales in the second year. My base year sales were 1 million. This equals 1.2, obviously. So if I multiply 1.2 by 100%, that percent of base year answer then would be 120%. So that's kind of how it works. If I change it to the cost of sales, what's my base cost of sales amount in year one?
Say 1 million.
Cost of sales base is what?
1 million.
No, I'm looking at the cost of sales.
Or you mean percent?
It's actually the same number as year two. So that's 1. So this,
Oh, you use 1%.
this is 100% then.
Wait a second.
So the amount didn't change, right? The amount did not change. If I look at margin, margin does change. Here, I'm at 500. What's my base amount? 300. And that doesn't come out very good. What is that amount? 1.666? Something like that? So this is 166 point, let's just go 1 decimal place as a percent. So that shows that we had a change in sales, 20% change in sales, which generated a 66% change in profit because our cost of goods sold didn't change at all. We get down to our selling expenses, 220. Prior year was what? 150. What percent, Ashri?
146.7%.
Excellent. Administration expenses, 60 this year, 50 last year.
120.
So that went up 100 or 20% basically, right? Operating income should have shown a pretty big increase, and it does. 220 versus 100. Obviously, that's 2.2, 220%. Huge change. Bankers would like to see that change, right? Interest didn't change at all, so that stays at 100. So we don't even have to do that computation. And then finally, our actual income before taxes was 195. Now it was 75 last year, the base year.
60%.
2.6?
Yeah.
Yeah. 260%. Again, huge increase, right? From our base year. Big change compared to our base year. So I would loan this person some money if they're doing that. And then going to year 3, we'll just do a couple of these. Maybe we'll get through them all. Here again, everything's based off of year 1. So we have to use the 1.7 million. Our base year was 1 million, which means 1.7, or 170% of change from year 1. I think they want me to go to one decimal. For the cost of sales, we were at 700,000 in the base year, right?
Mm-hmm. Yes.
Yes.
So we
Okay.
1 million
So we have 1 million
divided by 700.
divided by the base year 700.
142.9.
And it looks like our sales are increasing at a faster rate than our cost of sales, which is good, right? And then our gross margin, we're at 700. Our base year was 300. Which generates
233.3%.
233.3% change from year 1. Awesome. Selling expenses are at 250 versus 150, right? That's 1 something. 167. 120 versus our base year of 50. $2.4. So this looks like our administration expenses are accelerating more than my selling, so that might be a point of discussion, right? And then 330 divided by 100 obviously is 3.3. Still very good. And interest expense, still 100.
Yeah.
And then finally, the last one, 305 over 75.
Yeah, it's 406.7.
So again, a very good, healthy increase on our income before taxes. Much, it's even more of an improvement since year 2. So obviously this company is going in the right direction. So that's the horizontal analysis with a base year percent computation. The other type of horizontal analysis is this comparative analysis. This is problem 59 on your book, 59. So let's jump to that. Computation is a little different because we're looking for the percentage of change. So if you look at the heading here, percentage of change. This is more common. This is what I do quite often to see basically line by line what my change has been over the course of 1 year. So also this percent gives us an absolute, no, a relative measure. I'm going backwards. Absolute relative. Yeah, it's more, I think it's called absolute. In other words, I can use this measurement as a guide from year to year. It doesn't matter the amount, it matters the percent. Much easier to compare years. So here again, I wrote down the numbers from problem 59. Looking at the balance sheet, obviously we can also do the income statement, which are shown here. Here, I'm not going to do all of them. It just doesn't, it's pretty simple. So, what is our base year? Base year is last year. So, to do a percentage of change, we take the difference. In this case, we went from 100 down to 50. That's a $50,000 decrease, right? This is my base, this is my new number. From 100 down to 50, that difference is 50. Decrease, my base was 100, so that percent change is 50%.
Would it always be a positive number?
Ah, shoot. Thank you, Joe.
Uh-huh.
That should be a negative number. Thank you.
Okay.
I forgot the symbol. So to answer your question, no, it can be negative.
Okay.
Thanks for asking.
Yep.
Also, going on to accounts receivable, we have a difference, this time a positive 150. We were at 150. That's 100% change. 1, right? Would you be concerned about your receivables doubling, basically? Yes, I would be. What does that really do? Who cares? Why does a company just cringe when they see that? Well, it could be two factors. They have a huge amount of sales change, right? But what else could be a problem?
Because they're not getting cash.
I'm not getting the cash.
Right.
Right. So that is a problem, right? We're selling to people who aren't paying us. Is that ever a good thing? No. I hate credit sales. Cash sales are always good. It's because you got the money in your hands, right? So next one, what's the change? I went up 200,000. My base year was 400,000. That's 50%. Same is true of inventory. Is that a good thing? Again, depends. Timing's a lot of things. I might be gearing up for some large sale amounts, then it's acceptable. But if, again, I'm not turning my inventory, that is not acceptable. Prepaid expenses, we're looking at a 5,000 decrease. My base year is 30. What is that? That's got to be something small. 5 divided by 30. 16.1666. So 16.7% decrease, and so forth. I think that's enough. I think we get the ideal, right? Going down to the income statement, let's just do a couple of those, because this is where also I do a lot of analysis. So here we are. We went up 50,000, right?
Yeah.
My base year is 900. What is that? A measly what? 5.56, 5.6%. It's a positive number, that's good. So how does that look for my theory in accounts receivable? It's totally bad. If my receivables went up 100% and my sales only went up 5%, so what must now really be happening? I'm not getting it. Look at my cash. Bad, 50% lower, right, than what it was last year? I'd be in a panic mode right now. Who do I go see? Because I'm going to run out of cash here pretty quick. So what would you do?
Probably go to the bank, maybe,
I call my customers first, right? I talk to my salespeople second and start collecting money, right? No sales go out to, there's got to be certain customers that are not paying us. So very quickly we can figure out that problem. Cost of sales, 10,000 difference over 490. That's pretty good. The Trump tariffs didn't hit us too bad, right? So we got 10 over 490. That's only a 2% change. 2.04. So my sales are going up faster than my cost of sales, right? Good sign, good sign. We should be making more profit, and we are. So we're looking at a $40,000 difference here over the 410. Which is roughly 10% something. $9.76. So again, due to the rising sales and the effect of a somewhat less cost of goods sold increase, gives us more of a profit increase. So this type of analysis, especially that gross margin number, bankers love to see this because this is really our operation evaluation. Am I making money on the things I'm making or selling, right? That's the big thing with gross margin. That's why it's such a critical number to look at. And again, you can just go through the rest of them on your own if you wish. All right. Kayla, any thoughts on this? Were you inspired to look at your financials closer? Awesome. Thank you. All right. Vertical analysis is the other technique to review our operation. Vertical analysis begins on page 840 to 841. We talked about it as on the income statement, our denominator is sales. And if it's balance sheet analysis, we're looking at assets. It's the same accounting period, right? We're looking at one accounting period versus a horizontal or crossing periods. So within one period. Most QuickBooks programs have this vertical analysis automatically. So when you run an income statement on QuickBooks, they'll have this percentage computation already done for you. And they can show here again where it discusses either sales or total assets as our denominator. Example 2 is our example for this vertical analysis. Example 2 is on page 841. In its completed form, it looks like this. Looking at multiple years, years 1, 2, 3. Looking at the percent columns between 1, 2, 3, what do you see?
Record.
How's this company doing? Pretty consistent, right? That's one nice thing. Pretty consistent from year to year. So that's a good sign, right? You don't want big fluctuations. Accountants can't handle that. So it's hard to, when you change sales tremendously from year to year, cash flow is really hard to maintain. So being consistent on your sales and your cost of sales as a percentage of sales is relatively also consistent, shows a good sign that you are controlling your expenses from year to year, which is good to see. So overall, this is pretty straightforward. So problem 40 was the example that I'm going to use for vertical analysis. This is on page 879. And we'll just do some of these. I don't think we have to do them all for every year, obviously. Gets kind of redundant. I think once we get through a couple of these, maybe what I'll do is just go through the gross margin, so at least we can look at that for years 1 and 2. Do they go to 3 or just 2? It looks like they do go to 3. So these are the same numbers that we had previously. 1 million in the first year was 700,000 and generating a gross margin of 300. So all I'm doing, everything's division or divided by the sales. So 700,000, over 1 million is 70%. So 70% is our cost of sales, which then would generate 30% for our margin. Pretty common margin. 30% is not too bad. 150 over 1 million. It's 15%, right? $50,000 over 1 million. Is that 5%, right? Which leaves me with, I did something wrong here. I don't come out. thought I could subtract these.
You should be able to.
I know, that's what I thought. What am I doing wrong?
So I don't think you're doing anything wrong.
Oh, yeah. 15 plus 5 is 20.
Yeah.
I don't know why I thought that was 25.
Almost
I don't know about that. Maybe. Right? So if I subtract 30 minus 15 minus 5, I should get 10. And then 25 is 2.5% and 7.5%. By themselves, they really don't mean a lot. But when you compare it next to another year or another company, then it does matter. In fact, when they caught that person who stole from Oneida, remember he built his house in Florida, a condo in Florida? He used company money. They caught that guy because these percentages were higher than another golf course somewhere else. The golf course compared their operation to a similar one somewhere else, and their ratios were much higher than that other golf course. So ratio analysis, again, that analytical stuff that comes into play, very important. Many auditors use that for embezzlement reasons. So we'll do the same thing for our year 2. That way we can do a comparison. 700 divided by 700,000 divided by 1,200 is, I'm just dropping the zeros. A little easier to work with. Is that what you got? 58.3%? Must be. Remember, the cost of sales didn't change from year 1 to year 2. So that's huge. That's big. So 500 over 200, 1,200 is 41.67% for the margin. So now we can tell a story, right? We were at 30%, now we're at 41.6. Huge improvement. That's a lot. That's a huge gain in profit. So here again it shows that one, I'd be questioning this, right? Don't trust anybody. How'd you get to 700 when you had more sales? So you must have bought something cheaper, which could be. Maybe costs do go down. Or our labor was more efficient. Right? We didn't have as much labor cost. Or our applied overhead must be somewhat reduced here somehow, right? Something's causing that number not to move when our sales changed. I wouldn't trust it. Something happened. So we'd have to do some research on that 700,000 to see whether that's really legitimate or not. Going forward, 220. We're looking at 18.3%. $60 over 1,200, we're looking at 5%. $220 again over it, 18.3, just by coincidence. And then the 25 over the 1,200 is 2.08, 2.1%. And then the 195 divided by the 1,200 is 16.25%. So looking at a comparison of those percentages to what we did last year, much, much improvement. The only thing I would say is the selling expense. The selling expense. This is one that did change. It was 15, now it's 18. So that for some reason did change more so than the other expenses did. So that might be something to, again, take a look at as to why that jumped more than it should have based on the sales that we incurred. Did we pay more commission out? Possibly. Maybe a higher commission amount? Possibly. Maybe a salesperson got a new raise, could cause that percentage to go up. So that's the goal here, is rather than looking at all the detail behind the numbers, just use our percentages to see what areas we need to be watching and concerned about. What do you think? All right? Vertical analysis? All right. It just talks about this absolute measurement versus relative measurement. How size does matter when we're looking at numbers, but when we're looking at percentages are not influenced. It's comparison. You can compare yourself, like my example, if I'm Al's Hamburger, I can compare myself to McDonald's percentages. Size does not matter. All right. So now we step into ratio analysis, which is really what that handout is. Ratio analysis begins on page 842. Basically, our ratios, percentages, right? That's what the name is. There's lots of them. So I'm going to look at a couple things. Ratios by themselves mean nothing, right? We have to do a comparison somewhere, either prior year or with another company. That's when that ratio becomes more useful for us. There's also, Dun & Bradstreet has industrial averages, right, by type of company. So that too is a source for comparison purposes. How is the industry doing compared to you? Like my chart, my handout, my separate handout, the book also classifies our ratios into categories, just for ease of use. Liquidity is 1, leverage is 2, leverage is debt versus capital investments. It's kind of a catch-22. Banks like more capital investment, right? More secure. Shareholders like more debt because they're not on the hook. It's the bank that's on the hook if things go south. So you got to please both banks and shareholders. So that's where those come in. And then finally, our profitability ratios show us the extent of how we're doing with our operation. How are we doing with those? Okay, so we're going to start out with our liquidity ratios. This is on page 846. 846. The first one that we're going to look at is current ratio. apples, current ratio was 1.1. Let's better verify that. I think it was 1.1. Yep, 1.11. In the analysis, it's 1.11. This is very low. I would not, for a small business, there's no way I would be at 1.11 and be comfortable. I'd be like, wow, 3, 4, 4 would be better. So larger the number, the better. I get that from my clients all the time. Okay, I've got a number here, so what does that mean? Right? And should it be bigger or smaller? So in this case, bigger is better. So what does this tell us? For every dollar of liabilities, I have $1.11 of assets. Right? Current assets to current liabilities. If I was at 1.11, I'd be talking to my bank saying, I'm in trouble because I might not meet payroll. Because anything below 1, I'm short, right? Anything below 1, I'm short. All right. It does give us a definition of current within a year. We learned that in intermediate. And convert it into cash, so know that, please. You should know that as accountants. What is meant by current? Within 1 year, convert it into cash. Whether it's liability or assets, doesn't matter. Here they're saying 2 is a good ratio. Yeah, it's better than 1.11, but 3, 4 would be better. And it talks about a declining ratio. It could be more problematic than a low number, in other words. Our second liquidity ratio is the quick ratio. This is on page 848. We basically remove inventories from the list. So if you look at the formula for the quick ratio, where's my formula? Stink. Here it is. Sorry. This is on page 848. The quick ratio only has cash, marketable securities, and accounts receivable. No inventories. No prepaid expenses also in the quick ratio. So this is a more narrow focus, right? Because remember, inventory is not always easy to convert to cash. But receivables should be, cash is cash already, and marketable securities should also be very quick to turn into cash if we need to. So this is a safer measurement of our current asset to current liability ratio. So example 3 then shows both computations. Example 3 is on page 848 as well. And the answers that it comes up with, 2.4, not bad, for our current ratio. 0.9 though, only for our quick ratio. Again, anything below 1 means I don't have enough money, right, to cover my current liabilities in quick ratio assets, those three. So the goal is to get this number at least above 1, for sure, if you can. Does everybody see that on their handout? On page 1, it's the first two. So, current ratio asset test. I show the computation, and then I show descriptive words of what's in that ratio, or how we get to that ratio. So, here again, if I'm meeting with clients, this is a very important sheet that I discuss with them so that they can understand what these ratios mean and what their purpose is, right? It makes no sense to give them information that they're never going to use. So this is something I show them. All right. Let's try 141. Page 880. Again, computations are not hard. But we have to know what our current asset is, right? And what our current liability is. So in this case, they did a nice summary for us. So it's 29,340,000 divided by 16,300,000. Kayla, what ratio is that? $1.8. Awesome. So for every dollar, right, of liabilities, I have $1.8 of assets. Not bad, pretty good. Let's look at the quick ratio. We exclude the inventories. So we have cash, marketable securities, accounts receivable, this should be. I have 16 million on the bottom, 300,000. What's on my top number? $21,190,000.
Yeah.
Joel, do you have that ratio? It's one something.
We
1.3?
got 1.3, yeah.
All right, pretty good. Not bad. It'd be nice to compare it to another year or another month. You can do these monthly really easy, right? And show a trend, if it's going up or going down. Here, just as a reminder, larger the ratio, the better. But not too large. If I have too much in assets sitting in current assets, that money's not working for me, right? So I should be investing in equipment with that cash if I have too much. So it's okay to have some, but not 10 times or 12 times. You're just sitting on your money then. That we certainly don't want. You got to make money. You got to buy equipment. Keep your operation going. Turnover ratios, very critical. Page 848, 849. The biggest one is accounts receivable. are we collecting our money in the terms that we're offering our customers, right? So here again, if we have a low turnover, not good. Not good. We're not turning our receivables quickly enough. If I have 30 days is my turns, right? How many turns should I have in a year then? 12. So if my terms are 60, obviously I'm only going to have 6 turns in a year. So if I'm approaching 6 versus 12, I'm in trouble as far as turn of our receivables. So let's take a look at this measurement. It's, again, very easy, simple computation. We have our net sales. What is meant by net? What do I mean by net?
To subtract the return
Yeah,
and allowance.
less returns and allowances.
Discount.
And maybe discounts, yep. So it's gross sales, less our returns, less any discounts gives us our net sales. Because remember, we're not collecting that money, right? We're not going to collect that money from our sales through our receivables. So they're gone, basically. So we take our net sales divided by the average accounts receivable. So how do we get the average? We take our beginning receivables at the beginning of the year. We take our ending receivables at the end of the year and divide by 2. Is that accurate? Yeah, kind of. It's our average receivables throughout the year. Again, this can be really influenced by a big rush at the end of the year, right? So again, there's some timing issues there. But for the most part, it's pretty reliable. So here, and then it converts it into days. We take that receivable. No, that ain't right. This is not right. We can convert that 12 to days, 30, using the accounts receivable turnover in days. You take 365 days in a year, divided by our turnover rate, 12, that should give you the days that you have your receivables outstanding. So that's an error there. Accounts receivable turnover should be in the bottom. It's correct in my handout. All right. Example 4 is the example. Example 4 is on page 849. 849. And they're taking, here's my receivables. We've got to get an average. That's our bottom number, right? Sales is our top number, our sales for the year, 750. So our turnover becomes 7.5 times in a year, certainly not 12. 12 would be ideal if you're having 30-day terms. So what does that lead us? 48.7 days before we get our dollars back on our invoice. Not too shabby. Smaller companies, this would be pretty good versus larger ones. Why do I say smaller companies? That would be good, and maybe larger ones maybe not so. there's a pecking order. How much clout do you have if you're a small customer? You don't have a lot. So if you're going to get paid, you're probably on the bottom end of the totem pole. So smaller companies have a much harder time collecting their receivables than larger companies in most cases. Because I did the same thing to my vendors, right? Okay, let's try 43. We can practice this. It won't take long. And then we'll take our break. '43 is on page 880. We had 54 million in sales. Our average inventory, we had 5 million. We ended up with 7. Divided by 2 has to be what? Would be 6, right? That's an easy average. Nine is our number of turns in a year. Not too bad, it's close to 12, right? Not quite 12, but close to 12. So we take our 365, divide it by 9, our turnover. How many days is that? It's got to be 40 something, right? How much?
Yeah.
I said 40-something also.
40.6.
40.6?
Yeah.
So not too terrible, actually. 40 is pretty good, even if your terms are 30. Let me move this up, Joe. You okay with that?
Yep.
Can you see it now?
Mhm.
So again, the goal would be get it to 30 if that's what your terms are. Get it as close to 30 as you can. Maybe get this turnover ratio up to 10 or 11. That would be ideal. But again, this is a great way to analyze our operation and then to focus on what we need to correct. Also, you have to talk to your sales department, find out which customers are causing that rate not to be at 10 or 11. Maybe there's a few customers that are at that 60 to 90 range that are not paying quick enough. So we have to talk to them as well. All right, let's take our first break here. And the inventory ratio begins on page 850 of our book. Very important measurement. How fast do we turn our inventories? So here we're looking at obsolescence, something like that, obsolete inventory, and again, speed of completing our inventory, right, and getting it shipped to our customers. So instead of accounts receivable, we're now looking at average inventory. And instead of sales, we're looking at cost of sales, which is part of our inventory, right? So we're looking at raw material inventory, we're looking at work in process inventory, we're looking at finished goods inventory. So anyway, very straightforward computation. And then to turn it into days, right? This one they do have, right? Inventory turnover ratio
Yeah.
is on the bottom. 365 is on top to convert it into days. The example is 5 for this particular part. what numbers are we going to use? We're going to use our 400,000 cost of sales. We're going to use our inventories here, which in this case would be, the average would be 85, right? 85,000 into our 400,000. That should give us our answer of what? 4.7 times a year. So a little slow. So again, we might have too much inventory, we might have sluggish sales, something's going on. Should be more than 4. And then our days, 77 days before we get our inventory turned. So for some companies, maybe that is a good ratio. It really depends on the industry that you're looking at. Our problem for this is problem, 46. 46 is our problem. So they didn't give us the cost of goods sold number directly. What did they give us? They gave us sales and they gave us margin. So guess what? Give us a try. So in this particular case, I've got $3,948,340. I'm so glad they gave us a nice even number. And our margin is $1,859,260. I'm just going to keep that as my denominator because I don't want to do the math. The average inventory is $553,420, which seems awful low, plus $62,640 in parentheses divided by 2. Whew. I suppose I should have did that down here, huh? Let's move that down here. Beginning, ending, divided by 2 gives me how much? Tiffany, do you guys have that by chance? Let's see if that calculator works. Let's get it warmed up. It's got to be around 57,000.
58,030.
So what's my rate then?
36.
36
Yeah.
times? Wow, that's pretty good. And that's why, for that amount of cost of sales to have that little inventory, it's hardly in the operation then, right? So 365 divided by 36 is roughly what, 10 days? So every 10 days from inventory to sale, that's pretty impressive. So obviously we're not touching that product for very long before we sell it. Now if we're looking at fish, right, maybe 10 days is a pretty good ratio. I don't know. If you're-
Goldfish.
Or, yeah, fresh fish, I don't know, 10 days.
Yeah.
Anybody work in a grocery store? I'm just curious what the turnover. How long is a fish shelf life? Something to think about. Okay. There is another problem here doing all of them, but I think we get the idea. I'll put these ratios out here, guys, so if you do want to practice, they'll be out there. All right. Our next category is leverage ratios. Leverage ratios. So this begins on page 853. When we talk about leverage, how did we buy our assets? Did we use debt or did we use equity to buy our assets? Included in this is our analysis or discussion on interest, right? Banks charge interest for our borrowing, so that's also included in this area. So the first one they're talking about is called times interest earned, and it's a company's ability to pay their interest expense. At a minimum, we have to pay our interest, right? We cannot let that go. So that has to be paid back to the bank, because otherwise they won't loan us any more money. So how do we compute this? We take our income before taxes and does anybody remember on a financial statement, what's the order? You have income from operations,
Operating income. Interest,
and then what's after that?
interest, expense of
I think interest, yep. Extraordinary maybe, you know, those kind of other things. And then we have what?
income.
Before taxes, right?
Yeah.
So that's what we're using, is that beginning number, that income before taxes. Because after that we have our taxes, and then we have our net income. On a GAAP type statement, right? On a GAAP type statement. So we're taking that income before taxes plus the interest expense divided by the interest expense. So again, the number by itself means nothing. You'd have to compare it to other years, other types of companies. So here's our example. So we're going to take our income before taxes, right here, 265. I'm going to add the 15 to it. Gives me 280. And I'm going to divide that by the 15. So example 6 says 18.7 times I can pay that interest expense. So a very large number. So if I were a bank, this would be very promising that this company could handle more debt, right? They have enough income to pay me that interest expense at a minimum. So the larger the number, the better. I think in my notes on my handout for the leverage ratio times interest earned, it just says, am I able to cover all the interest charges? In this case, for sure. The other leverage ratio is our debt ratio. The debt ratio is talked about on page 854. Debt ratio is total assets or total liabilities to assets. So how much of our assets were financed by debt? How much of our assets were financed by debt? And a lot of farmers are struggling with this right now. They have too much debt for their assets that they have purchased. A lot of farms are now instead of buying their assets, they're just leasing their assets, right? Trying to keep that debt ratio down if they can. So, simple computation. And then finally, the third one that they talk about here is debt to equity. So here again, how much is financed by stockholders, how much is financed by debt? So this debt to equity is on page 854 as well. Just simple divisions. Again, by themselves, they mean little, but from year to year, they do mean, or can mean a lot of it, give you a lot of information. And bankers also like to see these computations, because again, they don't want to be financing a company that's already highly financed with debt. So example 7 gives us our debt ratio, gives us our debt to equity ratio, and they're saying that 60% of their assets were purchased with debt, 1.5 to $1 of equity. So quite a bit of it's covered by debt compared to the equity section. So for every dollar of equity, $1.5 of debt. Again, I can't say if that's good or bad. Depends on the company and the industry. We can try a couple of these. Problem 50, 882. Our first one is times interest earned. We got to use our little table, our income statement. We got to start with 3.5 million is our income before taxes. I'm going to add my interest expense of 1 million. Sean, Joe, don't take this the wrong way, but I'd be crying if I had to pay you guys $1 million in interest. Just saying. Divide it by 1 million. So, not good. Not a lot of wiggle room there. So, remember our textbook example is like 18.7. That's where it should be, not 4.5. That's pretty low. Total liabilities to total assets. $10,250,000. 16,400,000 of assets. How much is that, guys?
0.625 or 62.5%.
Okay. So for every dollar of assets, right, 62 cents has been financed through debt. Now that debt could be accounts payable too, right? We're borrowing from our lenders as well. So it's all liabilities, not just bank. And then our debt to equity ratio is what number? 1 something?
1.6.
Something like that?
Mm-hmm.
1.6 to infinity. So for every dollar of equity, I have $1.6 of debt. Again, a little heavy, I think, in this case on debt versus equity. So here again, a banker might say, boy, based on your industry, this 4.5 is a lot of debt, too much interest expense here. That 62% is a little high too, if you want to borrow from us. I think you're going to have to kick in, find some shareholders to kick in rather than get the money from us. So that's what these ratios are helping us to make a decision on. How do we finance our operation? Okay. After our liquidity, that's it for our liquidity ones, or excuse me, our leverage ratios. We get to our profitability ratios. Again, I have another one here, but I think you get the idea. Our profitability discussion, our chapter pages are starting on page 856 of our textbook. Lots of profitability ratios, especially if you're in the stock market, and most of the companies that we work for are not, but they do get somewhat involved into the stock market ratios here. Looking at a couple of things, not only profitability, but if you were investors, we're looking at dividends. Also, if we're in the market, how good our price is, our market price is also contained in this profitability section. So let's see what we have. Our first one here is called return on sales. Again, a very simple computation. Net income divided by sales. How much money are we making on every sales dollar is basically what it is. So here's that computation. What in cents do we make on every dollar of sales? In Apple's case, it was 23 cents. For every dollar. And they have a lot of sales dollars. I'd be really, really happy with that. That's my happy emoji. I'd be so lucky to be there, playing with that money. Whew. All right, so here we have our vertical analysis actually, and you can see that in this case, we have 4.6 cents, right, of profit for every dollar of sales. So, or, like we said, we could take, how do we get that 4.6? We took our 2,300 and we divided it by 50,000. That's our profitability ratio right there. Example 8 shows us that computation. Oh, this is in thousands, by the way. So the statement has, so there'd be three more zeros here. So the example 8 then shows us this computation. 4.6 cents is the return on sales. Another very important ratio is the return on total assets. Really shows us how much money we're making on our assets, right? How much return are we making on our assets? So this formula is a little more complex. This is probably the most complex one that we have of all of our ratios. The average assets, now you're looking at this total assets, so we're looking at both current and fixed, right? All assets contained in this ratio. So here again, we talked about having too much money on hand. Well, if I have too much money on hand, that will influence my return, right? I'm not using that money wisely enough. But what's different about this is here. In the upper section, for this ratio, I'm going to take my net income plus my interest net of the tax rate. So in other words, I'm taking the tax effect out of that interest expense. Because interest expense does what to my taxes? It reduces my taxes, right? So I'm taking that effect out. So if my tax rate is, what is my tax rate on this problem? Does it say? What's my tax rate? My tax rate is 50%. So 1 minus 50% times our 400,000 is 200,000. I add that to my 2.3 million in net income and divide it by my total assets of 31 million to get a 8.6 return on my assets. Now here again, if you're the owner of this business and the market, I can do the stock market and make 10%, well, I basically should move my assets to the market and get rid of this company. So that's the goal here, is to use this to analyze whether we should be in this business, or if the goal is 10% and I'm only at 8, what can we do, guys? You're the manager. Your goal is 10%. You're sitting at 8. What's one thing you could do to change that 8 to make it better? What do you got to do first?
The asset, reducing the asset.
Pardon?
The asset to
What do I got to do to my assets?
sell.
Yeah, I got to get rid of unused assets, right? If I reduce my assets, will that not increase my percentage? Yes, it does. What else do I do? Get more what?
Get
Sales. Maybe it's a capacity issue, right? I have excess capacity in my machines are sitting there. Or if I'm not going to increase my sales, what do I have to do as a minimum? Decrease what? Expenses, right? Reduce expenses. All of this will improve my percentage, right? It's easy to get the number. It's easy to get 8.6. The next question will be, how do I get it higher, right? That's what you're going to have to determine, is how you make that higher. And look at your ratio. I have net income on top, right? Assets on the bottom. So those are the two numbers you got to get higher and lower to get that number up. Let's try one. Or let's try the return on sales, return on assets computations. Problem 51 and 52 of our book. Again, we got to use our little table on page 882 for the numbers. For the numbers. So here we're starting with net income, 2.1 million. On 11,300,000 of sales. Kayla, are you still with us? Can you do that ratio? I'll show you the ratio again. What's my return on sales? 18.58%, I'm assuming, right? Very good. So for every dollar of sales, I'm making 18 cents, right? 18.5 cents. Excellent. So then my next computation, return on assets. Let's do our average assets first. We had, let's see. Do they give us beginning and ending? They really don't, do they? So I think we just take the total assets as is. So I guess I don't have to do the average. It's just 16.4 million of total assets on the bottom. And that income is 2.1 million. Plus interest expense, which is 1 million. Times 1 minus the tax rate. What's my tax rate here, guys? Kayla's got it. What do you got? 40. How did you get it, Kayla? Is it really? I don't see it, Kayla. Oh, yeah, that's 52.
Oh, yeah, at the 50.
Oh, that's where it is.
40%.
You're okay. I think that's fine. You're 40%. I was hoping you'd do it a different way. Here's what I would do. What were the taxes? What was the tax amount?
For 1 million.
1,000,004, right?
Yeah.
On income of how much?
To 1.
No.
No, you
Before tax.
Oh.
3.5 million.
3.5. Isn't that 40%? I hope it is.
Yep.
Otherwise, I would be totally confused. So that is another way, right? We don't have to give you the tax rate. If we know the tax amount and what income it's based upon, I should be able to give you an effective tax rate, in this case 40%. All right. So 1 minus 40% is what? 0.6.
Yeah.
0.6 of 1 million is what?
60.
600,000, right? So this answer should be 600,000 plus the 2.1. I should be now at 2,700,000 over 16,400,000, which gives me a return on assets of how much? 15%? 16? So for every dollar of assets, I'm making 16 cents on my investment. Pretty good. Anything over 10 is really good. So the bigger the number, the better, right? On our return on assets. Here again, if I'm not making that return on assets, we got to get rid of assets that are not in our operation, right? Or if we have too much cash, I better invest in some equipment to get my sales up and running higher if we can. Any question on these two? Return on sales, return on assets. The rest of these, again, unless you're in the stock market, not really use much more beyond this. So here, this discussion begins on 857. Return on stockholders' equity. Remember, there's a difference between common stockholders and preferred stockholders, right? Preferred is almost like a bank. They're paid interest, basically. They call it dividends, but it's really based on a percentage of something on their stock. Common is basically they get any dividends that are left over, right? So they were paid after the preferred stock is paid their dividends. So that's why you see this subtraction here. So who gets paid first out of net income? Preferred gets paid first, right? If there's any money left, then the common stockholder gets it. So that's why we're doing this subtraction here, to subtract out their dividends first. So example 10 on page 858 shows these computations. Again, we've got to take an average of the common stockholders' equity. In this case, 12.2 million. That's our denominator. In our numerator, they're just talking about the common, how they got to the 11,724,000. How much of this do we need to know, guys? Let's go back here. I gotta look at this. 858. Refers to the exhibits on page 844. So now I gotta go to 844. And 845 specifically, because that has our equity section. So what they're doing here, guys, the 11,724,000 is the 1,006,000 of common stock, the 4.8 million of preferred additional paid-in capital, and then finally the retained earnings amount of 5,324,000. That gives you the 11,724,000. So they are basically taking everything except the preferred stock. So in this number, there is no preferred stock. And retained earnings is going to the common stock shareholder. So once they have the average, then this just shows that summation. They're starting with the par value. They add the additional paid-in capital, 4.8 million, and then the retained earnings amount. So, once they have the average, then here's the income for the year of 2.3 million. This is the 8% preferred stock dividend, 2.24. So the common shareholders get a 16% return on their investment. Again, oh, I said 8%, it's actually 7%. Sorry. I just noticed that down here. It's 7% to get the 224. So preferred dividends are 3.2 million, 7% of that is 224. So we have to subtract that out of our net income to get our common shareholders a return. All right, so there's a little thing on Coca-Cola here too. Let's jump to our problem then. There's earnings per share computation. At this point, I think I'm just going to show them where they are located. Earnings per share is on page 859. And I think what we'll do is use our reference sheet to do these computations. And that's done with example 11. And then the price earnings ratio is on page 860. Example 12 is the price earnings ratio. Dividend yield is on page 861. And payout ratios 860 to 861. Example 13 are for those. So what I'd like to do is let's try 53, 54, 55 and do all of these ratios together. So let's give it a whirl. 53 is on page 883. So I do have the computations here, starting with return on stockholders' equity. Net income is 3.182 million. What's our preferred dividend amount? 4 million times what percent?
8%.
8%. So I'm going to put the 8% times 4 million of preferred stock, which is how much money? 320,000, right? So I'm going to subtract that dividend out of the net income. $2.862 million. That's my net income left after I pay my preferred stockholders. Average common stockholders' equity. So that I'm not gonna do here because it's too messy. So I'm gonna take, starting with 3 million. Let's do it this way. Starting with the 3 million. I'm going to add the paid-in capital, 4.8. And 4 million. This is all common. So that totals up to 11,000,008. December 31st, it was 3 million again, 4.8 again. And retained earnings is now 4.25 million. That comes out to 12,050,000. Seems like a lot of work to get the average, but that's what you gotta do. So now that I have my beginning and ending, right, I can add the two together and divide by 2. So my average is $11,925,000. That's my average common stock. 11,925,000. Ay, ay, ay. So I finally have my number now for my denominator. 11,925,000 for my average inventory. And what does that give me, guys?
I'm getting 24%.
24%?
Yeah.
Thanks, Joe. It came out exactly at 24?
I'm not I use the computer calculator.
Oh, okay.
So I don't know.
That's probably pretty close. That's close enough. So, pretty good. Actually, return for that stockholder investment, a 24% return. So that's pretty good. Okay, earnings per share. We've already got the net income and preferred dividends figured out. So we can again use that 2.862 million is our net income after subtracting out our preferred dividends. What was our weighted average number of common shares outstanding? How many shares do we have outstanding? Our par is 3, so we must have 1 million shares outstanding, right? And I had 1 million in the beginning of the year, 1 million at the end, so the average is what? 1 million. Yeah. So all I gotta do is divide this by 1 million. So $2.862 per share is the earnings per share. $2.86 per share. Again, the numbers don't mean much by themselves, right? We'd have to compare with other years. Dividend yield. Now that I know the dividends per common share at 2.86, I'm going to divide by the market price per common share, which is how much? That they have to give us, I hope. In 54, what is the market price?
I would say 5150.
51.50. Yeah. About 5.5. Dividend yield. Dividend payout is common dividends divided by net income minus preferred. What is my dividends? We have to look to 55.
$2.6 million?
Yeah, 2.6 million. Probably 55. Giving us that information. And again, my net income minus my preferred is 2,862,000. One something, huh? Oh, not one. Sorry. Point what?
91.
Point 90. That seems awful high. So for every dollar of net income, I've basically gave them 91 cents in dividends. That's a pretty high ratio. I don't know if I'd be doing that. Because what's this supposed to be for? Reinvestment, right? Yeah. Must have nothing to buy. What else? Why is there incentive to give a high dividend to shareholders? It jumps up the price, right? People like to get big dividends, right? And then market price per share divided by earnings per share. Our market price was 55 or 51.50. Sorry. So our last one, 51.50 divided by 2.8. 862? I think they want us to drop one of those, go to 2 decimal places. So market price divided by earnings per share gives us a price earnings ratio of 18. Again, those are stuff that bigger companies deal with. I have never done these ratios other than in this book. I'm mostly on the profitability ones in the beginning, not these equity ones. And obviously the liquidity ratios and the debt to equity ratios, leverage ratios, I do quite a bit. All right, that is my overview of chapter 15, lots of ratios. Use the template that I gave to you as a guide as you answering those questions and so forth. Obviously, you can keep it because some of you I will not have anymore, right? Sad, sad day, sad day. So keep this as a memento from me. Put hashtag awesome on here, kind of remember that. But if I don't see you guys, I wish you all the best of luck in your future, whether you're going on to school or not, or your future career choice. Even if you don't end up in accounting, I think you've got a very good background in some of the things that at least you know understand some things about accounting, which can be useful in many other areas, sales, management, and so forth. So I wish you all the best of luck. Good. Kayla, it's been a pleasure to have you as one of my students. I wish you all the luck in the world. And if you make millions, let me know. I'll be your accountant. That's for everybody. Okay, good deal. The rest of the night is yours, everyone.